Okay, class, we left off with the first two closing entries that can actually be viewed on page 171. Fees earned was closed to income summary for $23,450, and all expense accounts were closed to income summary for $5,150. If you turn your pages over to 173 and look at Exhibit 17, you will now notice that the income summary ledger account has a credit entry of $23,450 and a debit entry of $5,150, leaving a balance of $18,300. $18,300 needs to be closed to the capital account. This $18,300 that we're closing income summary to capital actually represents the net income for the company. If you turn over to page 169 in your book and look at Exhibit 14, you will see the income statement for Kelly Consulting, and you will notice that revenues are $23,450, total expenses $5,150, and net income $18,300. We're now closing income summary to the capital account. By crediting the capital account, we are increasing capital for the amount of $18,300, which simulates what happens on the statement of owner's equity. The last journal entry that we will cover is actually when we close the drawing account. Drawing account being the temporary account, capital being the permanent account. By debiting capital, we're decreasing the equity by $6,000, which again is what is represented on the statement of owner's equity. You can see both this representation and this representation on the statement of owner's equity on page 169, where we add in $18,300 to the equity and we take out $6,000. I do want to caution you here, though, that in the third journal entry of closing income summary to capital, we're not closing the actual capital account, we're closing income summary. A very common mistake is to try to close the capital account. And I want you to remember, capital is a permanent account and does not close.